When you invest in a company's stock, you aren't just speculating on a ticker symbol. You are becoming a legal part owner of a living enterprise. This means every dollar of profit that company generates reflects directly on your portfolio's ethical standing. Today, we step inside the data pipeline and construct the primary gatekeeper of equity screening, the business activity filter. Professional Shariah screening does not look at stock charts, it looks at corporate operations. We approach this through a structured, two-tiered validation matrix. First, we run a macro filter to eliminate companies whose primary purpose is unethical. Second, we perform a deep segment audit to calculate the exact percentage of non-permissible revenue generated by mixed business models. In modern global markets, finding a massive conglomerate that is 100% pristine is exceptionally rare. A technology giant might hold a small cash management account that yields interest, or a logistics firm might transport cargo that includes prohibited goods. Under international AOIFI standards, a company remains a candidate for investment only if its incidental non-permissible income stays strictly below 5% of its total gross revenue. Tier 1 is instant and absolute. If a business derives its primary identity, our major income, from sectors built on exploitation, its equity is immediately disqualified. This includes conventional banking and insurance companies funded by interest, vice industries like tobacco, alcohol, and gambling, and manufacturing operations focused entirely on offensive weapon systems. The primary mistake retail investors make is relying on a company's public relations or marketing campaigns. A hospitality group might win sustainability awards for its eco-friendly buildings, but if its main properties generate substantial revenue from on-site casinos or alcohol distribution, the underlying asset violates the core boundaries of Monsieur. You must look at where the money flows, not what the brand states. When auditing complex, diversified corporations, we have to look past the top-line consolidated revenue. We must open their regulatory filings, such as the 10K or annual financial statement, and audit their specific segment reporting. We parse every single product line to identify hidden interest, financing arms, or prohibited commercial operations. Let's look at a real-world corporate case study, Apple Incorporated. Apple is globally dominant in consumer hardware and digital services. On paper, it is a clean technology powerhouse. However, when we perform a manual segment audit, we have to closely examine Apple services, specifically looking at financial products like Apple Pay, Apple Wallet, and the interest-bearing mechanisms behind the Apple Card. When we run the math on Apple's operational data, the revenue generated from financial transaction margins, credit services, and unearned interest lines accounts for less than 1.5% of its massive consolidated income. Because this is well below the strict 5% boundary established by AOIFI, Apple cleanly passes the qualitative business activity screen. However, passing the business activity screen does not mean an asset is entirely free from ethical complexity. Technology giants like Apple frequently hold massive cash reserves that inevitably generate incidental interest income. This minor contamination does not fail the stock at this stage, but it requires us to perform a precise calculation known as dividend purification later in our framework. This qualitative screen doesn't just look for obvious prohibited products like alcohol or gambling, it also protects your portfolio from hidden structural issues. By filtering out financial companies that deal heavily in unpriced risk, complex derivatives, and predatory credit structures, we automatically insulate our capital from the exact systemic vectors that cause major market failures. Once a corporation cleanly passes the business activity filter with less than 5% non-permissible revenue, it earns the right to be audited mathematically. We take the successful candidates and advance them to Phase 2, the quantitative financial screen, where we measure their interest-bearing debt unliquid assets directly against their true market value. The business activity screen forces us to treat investing as a partnership in a real enterprise. It demands that our returns are derived cleanly from human innovation, product sales, and genuine value creation. In our next lesson, we cross into the numbers. We break down the exact mathematical thresholds for corporate leverage, debt containment, and liquidity rules that separate an ethical balance sheet from a toxic debt bubble. Hit subscribe, and let's keep building wealth with a conscience.